Okay.
Welcome, everyone. We are thrilled to have with us today Larry Botel, who is managing partner of Joss Realty Partners and president of Alliance Sports LLC. So maybe we'll talk a little bit more beyond just real estate today, especially for you sports fans out there. But Larry, thank you so much for joining.
Thanks for having me.
It's been wonderful knowing you all these years. Somehow I always just see you out there. Usually Michelle Klieger's in tow.
Exactly.
We love
That's
Michelle. Shout out to Michelle. But
I'd be a hermit if it wasn't for Michelle.
Yes, but you are definitely out there. So we appreciate it. So Larry, just for our audience, let's start with Joss and maybe give a sense of what that portfolio looks like. And then maybe we could talk a little bit about Alliance Sports later in the discussion.
Yeah, I mean, Joss has been around for 20 years.
Mm-hmm.
Kim probably doesn't know, but you may remember Broadway Partners,
sure,
which was kind of the first time I did this with Scott Lawler. We built a business around high net worth syndications and buying office buildings. Left there in 2004, 2005, and then started Joss. Same business plan: buy boutique buildings in the tier one markets, raise the capital through high net worth equity, and build a portfolio. Mm-hmm. So sitting here today, we've done 32 deals. Wow. Probably 95% of them have been in the office space. About $1.2 billion in total transactions. We've executed in every major market in the country. We have 6 assets today, gone through a couple cycles, right, which I'm sure we'll get into. And then coming out of COVID, we had 6 assets, about $400 million in total market cap. And it's been an interesting 4 or 5 years for sure.
And Larry, for our listeners, which markets geographically have you been most focused in?
Most of the assets that we bought over the life of the company have been in DC, but Northeast Corridor, right? Boston, Philly. We've done a few things in New York, and then San Francisco and LA.
Yeah.
And a couple things in Florida. Those were more like sort of partner type of deals. I don't find Florida to be a robust office market because no one really goes there to work, right? So most of the activity that we've had has been in the larger office markets.
Great. And I've got to ask, Joss, how did you come up with the name? What does it stand for?
I'll name drop. Steve Klein was my original partner. We both rolled out of Broadway. Steve as SL Green, and then Broadway, and then Joss. And he had 2 daughters, Samantha and Olivia, and I have 2 sons, Sam and Josh. So JOSS was and it's so funny. Like, I think I ran into Sam recently. I think she's at Goldman or somewhere else now. And I'm like, you're the S and the other S in Joss. So yeah, she's like, I know. So it was just, and I think luckily it didn't mean anything bad in any sort of foreign language.
Oh, good.
So we got lucky.
That's amazing.
It's good to know. So Larry, maybe talk a little bit about what you see in the office opportunity. And, we were talking before the show, and this has been several decades now that you've invested in office. You've stayed committed to it. So what is it about the value proposition versus, say, multifamily or some of the asset classes that have you remain focused on it?
Yeah. Look, I got into the business in the S&L crisis, right? Basically, graduated in 1988, started working very institutionally. And so the office business is something I've always been attached to. My first job was at Peru. They were the largest office owner and lender in the country at the time, back in the late 80s and early 90s. And the narrative around office, especially for the last 5 years, has been almost like it's going to zero. And it's not 100% problem. And I've kind of said this from the beginning. It's a 20 or 30% problem that needs to be dealt with. So you have 70, 80% of office buildings that are going to be fine, that are going with the right capital structure, with the right leasing agent, with the right ownership, will lease and be valuable. The market, especially institutional investment wise, does not think that, right? Or they're not acting that way, or it's so far down the list and they got other priorities that the biggest problem in the business right now is just the total lack of a bid, especially on the equity side, although the lending market isn't great either, for office. So you've had this pretty massive repricing going on, and you run math on, and we were just talking about your deal in Atlanta. You run math on these deals, And you just can't believe that the risk adjusted returns to equity are where they are, 20, 30% for well leased office buildings in great markets that, you can capitalize and you'll be okay for a long, long time. And
Yeah.
it's just because there's no institutional bid. This has been going on for, close to 6 years now. And to me, and, we were working on an IPO to solely take advantage of that. It's such a tremendous opportunity in the real estate space right now, especially relative to other opportunities.
So when you're bidding on an office deal, what are the main factors that you're looking for? Is it the tenancy, the wall, the capex requirements, the market demographics? Like, what are your core, I guess, like check boxes?
I mean, it's submit, and if you look across our portfolio, what we try to do is create best in class asset, singular, or maybe assets, right, in the larger markets that we can lease, right, that'll position themselves for leasing in their submarket to be head and tails above everyone else. And whether that's from a, quality of the asset perspective, whether that's from a rental perspective, whether that's from a locational perspective, whatever it is, that's what we're looking for, right? And it's, maybe you'll be one of 10. That should be fine in a big market. Maybe you'll be one of one or one of two, which we've had in the past. Broadway, we own Pickwick Plaza, which was exactly that narrative. We own a building in downtown Napa right now, which is one of two. Like that's what we were attracted to. So it's not something specific necessarily. It's just leasing is the key. And if you can position that asset and capitalize it properly and staff it properly and hire the right, agencies to make it extremely leasable, obviously the returns make sense. That's what we're looking for.
Yeah. To go back to the opportunity now, because I'm thinking about, 2015, 2016, like last peak point in the market, here in New York, there was no differentiation in cap rate. It was a 3 to 4 cap. It didn't matter what it was. It could be multifamily, it could be office, didn't matter. It was a 3 to 4 cap. I mean, now you've got this world where you have multifamily that's still safely trading in the 5s. In some cases, we've seen some deals in the Southeast trade with a 4 handle. Oh, yeah. And we're talking about office deals that you can buy 85% leased at a 10 cap.
Yeah.
And
I got
you're
one
more
95% leased,
yeah.
and I'm being quoted a 12 cap.
And I understand why it's going to take a while for the kind of the institutions to get the comfort and to, get back into the flow. And we are starting to see examples with that, 590 Madison Avenue and some of the, the Vornados and SL Greens here building. But, for the retail investor, right? I mean, that proposition, I mean, is it still just feel like, I'm just trying to think the hesitation on their side to invest in office right now. Is it still just kind of concerns about what's, have we recovered and gone back to work from the pandemic? Is it like what's happening in the future with what AI is going to do to the workforce? I mean, what is it that's still keeping retail investors away?
Well, look, I think a couple things, one is macro, even beyond office. And the last, let's say 6 to 9 months, I don't know how many times, I don't think it's happened over the last 6 or 9 months, but there was this period of time where you would sort of get to a point in what you think is this cycle and say, oh, now's time, right? Now the purse strings are going to come loose. People are really going to start investing like they used to. And every time that happened, let's say over the last couple of years, something would happen geopolitically, macroeconomically, something would basically say, have everyone do this again, right? Or sit on their hands. So that's the environment we're sitting in now. Office is recovering. Fundamentals are stabilized or improving in every major market in the country. You just look at the numbers, right? It's just this sort of cycle, at least from a fundamental perspective, is over, at least, with regards to the downside. But then you look at the overall macro investment market, office is still, let's say, number 10 on the list.
Right.
Data centers, multi-industrial, go down, whatever's coming next. Like, so it's going to take a while for it to get to office. I don't understand why there isn't an institutional bid right now. What you do see, which is interesting on an institutional level, is some of these office REITs being taken private, which is a long-term play on office valuations, right? Because let's say your Elliott took one of them private in the last like 6 months. How long would it take me to build out the portfolio that they bought on a REIT basis? So they're willing to pay a premium, which I do think REIT stocks in the office market are trading at a premium to private. Like if these guys started unloading their portfolios, they would get crushed, like relative to their equity value, because the private market just isn't there. But the cost of aggregating a portfolio like that and then taking advantage of the pricing dynamics that are right now, there's some smart money out there going for it. The only place I've really seen it is in that space, and it's happened 2 or 3 times, and it makes total sense, right?
Yeah.
Let's say the market value is $100. If you put it out in the private markets, it's worth 90, but what the cost of building that portfolio is probably 20 or 30 or 40, right?
Sure.
So guys are taking advantage of that. They have patient money, and they'll eventually sort of unwind these portfolios. And when office is back to being an institutional quality type of investment asset, and look, they're going to kill it. So it takes time. This cycle is different in that, and I equate it to the S&L crisis. The S&Ls all, stopped funding. They all wound up like collapsing, and all of a sudden, everyone kind of followed, and there was no liquidity in any real estate assets. And it was bailout by securitization. It was bailed out by CMBS and other securitization methods. This cycle had that same type of thing when it came to office, and now there's nothing really there to bail it out other than time.
This really speaks to the importance of leveraging the data to get a really good risk adjusted return. And I just feel like so often and we're seeing this like live at the asset level. If you have 7 years of WALT and it's 90% leased, and there's below market leases, and it's a number one office submarket, and then still people are so reluctant because of the headline risk. So it is an opportunity to get an amazing risk adjusted return. But it is all about the data and having that inside information.
Who's going to be that first, acquisitions VP to walk into the office at Brookfield, who's now unloading everything, and say, I got a great office deal, right? Go to investment committee with that. That's the mentality, right? And you're right. You're exactly right. Like, the information is so much better than it was in the 90s, right? You can now actually find information that really can build a narrative around what your investment strategy is and how successful it'll be, and do the analytics and do upside and downside scenarios based on real information, right? So it should be coming together for people that, wow, I can invest in a relatively low risk asset and make a 30, but it's not.
It feels like what's still happening is a lot of these, office as an asset gets painted with one brush. And even thinking about, we keep talking about this deal that we're working on in Atlanta, and it just gets put in the bucket. Oh, it's suburban office. So if it's suburban office, it can only trade in the high teens. Well, actually, there's different submarkets and different demographics. So I think it's a reminder for all of us that it's, again, really to look at the data and what's happening, on the specific submarket and class. But, Larry, one thing I was thinking about with, what would it take for the institutions to come back to office en masse? Because I've asked this question a couple of times is, I think there's no shortage now of interest for value add, right? Where it's, hey, if I can buy distressed office at a discount, but then the question is, where's the takeout? Where's the core buyer? Once I've repositioned this, who am I selling it to? So what would you say to that?
I think the debt markets need to get more conviction. Like, you hear, a lot of friends, been in the business a long time, got a ton of friends in CMBS scattered over all the banks. And, you talk to them at a cocktail party, which you've seen me at, as you said.
Yes.
And they're like, yeah, we'll do that for a 10 debt yield.
Right.
There's no 10 debt yield out there. Like,
right.
You throw a real deal in front of them and it's a 12.
Right.
So there still is no, and they'll do multi at 7 or 8.
Right.
So there's this 400 or 500 basis point gap in debt yield, which again, doesn't make sense. Doesn't matter what the building is, doesn't know how it profiles. Maybe a New York fully leased asset for 12 years is a difference, but not an 8-year wall, great tenant suburban office building that's 100% leased. I got a 12 or a 13 debt yield quote,
Right.
multiple times. So that needs to change. And that goes back to our conversation about liquidity, right? The liquidity needs to be better. But I also think there needs to be some of those ones at the top of the list, right? The 1 through 5s, they need to start, creating a little bit, or the opportunities need to start, becoming so expensive that the institutional money, which there's a ton of it, right, out there on the sidelines, starts to look at the bottom 5. And, does the data center thing start crapping out, or does the regulatory stuff around data centers just become too much to bear, or the electric cost, whatever it is, right? I think that needs to crumble a little bit. And look, the big difference is like an institution can, again, I go back to like that aggregate number. Institution can dedicate, $1 billion to one deal in the data center space.
Right.
Dedicate $1 billion to one deal, to 30 deals in the office space, or 40 deals in the multifamily space. So it's all about allocations, right? So they're able to like sort of keep their money flowing into data centers or large industrial deals, and allow to keep their, what they're allocated to real estate, where they want it to be. So, I think the data center business going through a cycle will help office a lot.
Interesting.
And then hopefully the fundamentals continue to prove themselves out, and, people don't get scared of AI. And I also think you got to be careful as New Yorkers about feeling like or not recognizing that we are in a bubble to some extent. We're in 5 or 6 markets. They all feel a little bit different. Like I would not want to own a half leased office building in a Midwest secondary market. So, I think being in the major markets makes us a little bit spoiled when it comes to office. But we do a lot of investment in Philly, and, West Market in Philly feels very different than Fifth Avenue in New York or Park Avenue in New York.
Right. Let's jump into some office deals in your portfolio. We saw that in March of 2020, you closed on a Creekside Way in San Jose. That was like $140 million. How did that deal hold up? Because obviously the timing was March 2020. What was that process like when COVID hit, and how has that deal performed over the past 5 or 6 years?
Well, and not so well is the best answer. So the investment strategy around that building was brand new building in Silicon Valley, quality triple net lease tenant for I think it was 12 years. Not a credit, right? Rated credit, but a good business that had been around for, like I said, 25 years. And we made the judgment call that there was no way they were not going to pay their rent. Their lease started in March 1st of 2020. They consolidated offices into this spectacular building in Campbell, California, which is like a, sort of a second tier market inside Silicon Valley, but very middle management, upper middle class residential, tons of amenities, great space. And, I think their rent starting out was like $4 triple net, $48 in annual terms. And that same building would have leased for twice that in Mountain View, or, some of the more close in, Silicon Valley burbs. So they move in, COVID hits, they empty out the building. Silicon Valley was very slow to come back from a regulatory perspective. And this was an in the office firm from the get-go, and always wanted people back in the office. And what happened was when they tried to bring people back in the office, there was no one there. There was no one in the Valley to basically bring back that represented their, sort of middle management, middle salary type of employee base. So they wound up outsourcing a lot of their businesses to, offshore, or, letting some of their employees stay remote. And, the building, sadly, while they're spread out all over the place, is maybe, 20% population occupied. But the tenant continues to pay rent. We have a year left on. We did a great CMBS loan, literally right before COVID, as rates were falling, like through the floor. So I think it was 3.6% interest only for 7 years. But that's burning off in about a year. We'll see. But look, it's a great building. It's great real estate. I'm confident we're going to figure something out in order to, either recapitalize, lease it up, recapitalize it, sell it to a user, something like that, that'll result in a decent return for our investors, who have been getting coupons for 6.5 years now, good coupon. And we raised $57 million around that deal in high net worth capital. It was by far our largest deal. The momentum was great. And then, things happen, right? GFC happens, COVID happens. So, but that it's great. And as I said, great real estate. It'll lease, our timing seems to be pretty good in that AI is really creating momentum in Silicon Valley. And as I said, the building's unique. It's you can't find 150,000 square foot brand new, little old lady from Pasadena car, right? Because it hasn't been used at all.
Right.
And we're going to, aggressively go out and try to find that tenant to lease it long term, and then realize something good for the investors, when the debt matures.
Yeah, we're really bullish on San Francisco and that whole area, buildings and all of those kind of micro markets getting like $8-9 a foot, triple net, 2,000 a foot trades. So it's
hopefully it gets
it's a mixed
back
bag.
there.
Yeah, but it's interesting that even with that experience, you're still really bullish on office as an asset class. How has
when
that
it's pricing at 25% of what it used to?
Right. Well, I was going to say, how has that experience after experiencing that 2020 purchase? Now, when you're looking at a deal, has that sort of shifted your focus at all, or what lessons did you take away from that specific deal?
It's so interesting. I don't know what lessons I can take away from a pandemic.
Yeah.
Right.
Everyone can talk about, we can run downside analysis. Could you really run downside analysis on a pandemic or the GFC? The GFC, you could kind of, if you were a smart investor, you kind of see it coming. What we didn't do, and I think it was for a number of different factors, was we didn't start buying out of COVID when there was some pricing adjustment, interest rates went pretty low. There was that sort of window of about 12 months where you could have made some pretty bad decisions, and we didn't, because we weren't really sure how to analyze an office deal, right? Because you didn't know what was going to happen with return to work. And again, not going to zero, but could it go to 60 or 70? Instead of 80 or 90 eventually.
Mm-hmm.
Just you had no idea, right? Because there was no stability in the fundamentals, and there was, you could get debt, you could probably raise some equity, but it was just impossible to understand what was something really worth in the office space. Now you sit here, like I said, the fundamentals are stabilized, and to me, I was young and then out of the S&L crisis. But there were plenty of guys that build big office portfolios, buying buildings, especially in New York, for like $30 a foot. And it was the same thing, right? They were leased, they were fine, they were well located. And it was just this complete lack of capital that created this opportunity. So everything's been repriced, everything. And even the deals in Manhattan, and I'm sure we all realize it. They're nowhere near the valuations that these buildings are worth in 18 and 19, not even close.
Right.
There's capital coming in, they're hitting 4 digits a foot, right? But it's not 2,000 a foot, it's 1,000 a foot.
Right.
So anybody who's doing anything right now is taking advantage of the repricing. And whether it's 40% off or 80% off, there's been a repricing in office that's pretty substantial.
How has the fundraising environment been for office in your experience?
Terrible. Now it's hard. Yeah. It's horrible.
But back when you did, to raise $57 million, and it's interesting because I never thought of Broadway Partners as a syndicator. I just assumed
that's how we started.
That they were you were just bringing in institutional capital. But what does $57 million look like? Is that 200 investors? Is that high net worth? Is it family offices? Like, how, what does it look like, and how do you go about creating that network?
The Broadway history is good.
Yeah.
You know, and at Joss, we never went to institutional as much, right?
Right.
But we pretty much stuck to the high net worth investors, because we weren't trying to buy $1 billion worth of real estate. We were trying to buy, $500 million worth of real estate. That was the goal. But at Broadway, we started, I think the first deal we raised $1.2 million amongst 20 friends and family. And then the next deal was like 4 amongst friends and family. But a couple of those friends and family were like Alan Landis, who, I'm sure you remember, and Scott, Scott still runs that business. And I think Steve Roth threw a little bit of money in.
So you guys were just going to, it wasn't the proverbial dentist or doctor. It was someone who was in the real estate business, maybe working at a big shop. They said, okay, I like this segment of the market. You guys know what you're doing.
Yep.
And then they start telling their friends.
Yeah. And then it expands, right? That network just expands and expands, and they tell their friends. Pickwick Plaza, we brought in our first institutional investor, which was Scottish Widows. And on Creekside, we brought in Qualitas, who was an Australian, much like us, like a family office that raised high net worth capital.
Right.
And obviously, had we sort of, gone from there, we probably would have done a lot of other things with them. So it starts with that little friends and family network. And then obviously a lot of us in the business are associated with real estate people. So it sort of builds from that. When our term ended at Broadway, Steve and we had to start from scratch. Like, we had non-competes, but we wanted to jump into the business. So we actually, and Steve was a big part of that, created this new network that had nothing to do with the old network. And look, timing was right. It was 2004, 2005. And you could actually jump in. A lot of people wanted to buy, own real estate. Right. And that was the trick. Now today, and I'm pretty active at Georgetown, and I know a lot of the younger people that do that are trying to do this. And my question is like, can you do it? We were back in the Broadway days, back in 1999, we were kind of pioneering, right? Where 2 or 3 guys just say, I'm going to go hang a shingle and start buying office buildings, right? Could you do that today in any space, right? Without some family money, or without I don't know what, but there are people doing it. It'll be interesting to see what this cycle looks like, because it became very difficult to do what we were doing without having institutional capital. And the difference was 20 years ago, Blackstone, you go to Blackstone for money, right? They had a real estate fund. They didn't have real estate people. So as a sponsor, you went to them and said, I got a deal. They're like, oh, deal looks great. Gave you money. Now these big funds have real estate platforms. They don't need us.
Right.
So the business evolved where it became much more difficult, or sort of fork in the road. You either stayed what we were doing, which is just kind of cobbling together money for deals, or you needed to become so big that you never had to worry about capital. Right. So now, kind of coming back in this cycle, will guys be able to do what we did? I don't know. I hope so, because I'm rooting for them. But it's different.
What advice would you give anyone who's looking to break out and start something of their own, like you did today?
Yeah, I would get educated. I'm a big advocate of going back and getting your post-college graduate degrees, because I went to University of Chicago, and it taught me things that I would have never known had I just stayed in the real estate business. And I can sit at a table and understand securitization way better than most people in the real estate business. I mean, just say it flat out. Don't want to be obnoxious, but I mean, I was taught efficient market theory when CMBS was being created, and that's all about efficient market theory. So I kind of got it. Then I went to Fortress, right? And that's all they did, right? They're not really a real estate shop. They're a debt and trading shop that uses finance to create opportunities. Would have never understood that had I not gone back and got my MBA. So get educated, and whether that's going back and getting your graduate degree or working somewhere, right? Work for an institution, because I think fundamentally you need to know, you need to have all these tools or a knowledge of these tools in order to be a real estate investor. You need to know finance. You need to know about buildings. You need to know about people, right? You need to know about, positioning buildings properly. I don't know how you learn that. If someone just says, "Oh, I have a nice aesthetic, view on things," and they just go out and start building condominiums. Like, you need to know about everything. This business is not easy. It's not complex, but it's not easy, and you need to know all these different things. So
Right.
be educated. Like, I think we started Broadway when I was 34. And I think that's too young, to be perfectly honest. But I worked for Pru as an analyst. I worked for Mutual New York doing workouts. I worked for BlackRock, UBS, what eventually became Fortress. I had all these tools that I could then take to the investment business, being a principal investor. You kind of need that to in order to be successful and not just be lucky.
Mm-hmm. And you started talking about it before, but along those lines, the capital raising piece, which is so important when someone's looking to branch out on their own. I think probably the one thing that's typically holding people back is that lack of capital, because out of the gate, unless if you worked with one of the biggest funds out there and you're recognized, very hard to get institutions to take a bet on you. So is the road still to go start with the friends and family, do a couple deals, show proof of concept, and then make that leap to the institutional side and start doing bigger deals?
I mean, you need to develop a track record. You at least need to show, especially if as you like go higher up the ladder relative to what type of investors you're getting, again, trying to get to the top, which is institutional, you need to show you got deals done. Right. I mean, I think the most, and the narrative around that has been the same for a long, long time. You need to show pipeline, right? You need to show there's a there relative to your strategy. You need to show a strategy and be relatively focused around it. And then, you need to be able to say, I closed these 2 deals in the last 6 months and I'm looking for the next round. I don't think you necessarily need to show track record. That track record, I think, was always a little bit, I'm not saying you walk in the door and you tank 10 deals, but if you're starting out and you don't necessarily have that track record, I don't think that necessarily eliminates your ability to raise capital. Mm-hmm. But you do need a pipeline. You do need a strategy. You do need a couple deals like under your belt. And even if they're small, but you need to be able to say, I closed this and this over the last, 3 or 4 months, and this is the next deal down the pike. And by the way, my deals are doing pretty well.
Mm-hmm. So there's another deal that we'd like to ask you about, which is the East Market project. So
only ask about the big deals.
Full block, $500 million mixed use office, retail, apartments, and then you also had the Roost Hotel. Walk us through your vision and process here and what your competitive advantage was.
So I'm born and raised in Philly, which is probably the only reason I would have ever gotten involved in East Market. But complicated deal. It was a quasi-public partner owner of the property called the Girard Estate, which I think at one point was the largest landowner, Stephen Girard, largest landowner in Philadelphia. They ran a process in, I guess it was 2005, to do a long-term ground lease on a full city block right at Main and Main in Philadelphia, except it was on the east side of Main and Main, not the west. And west was the traditional office market. East was always this sort of mishmash of some GSA property, a big suburban train station, Reading Terminal Market, but never not an old Disney Quest site that never happened. Like just this sort of, almost hole in the donut that never got figured out. So they do this process, and lots of trials and tribulations. So we eventually foreclosed on the guy that won the bid, wound up bringing in National Real Estate Advisors as our partner. And that's the IBEW pension fund. They were building out their development platform and just willing to write a lot of checks to get electrical workers jobs, right? That's fundamental. So with them, we were able to do this mixed use, what eventually became a $1.2 billion project, because Jefferson built a cancer center for like $600 million
Wow.
as the last piece of the site. And it's been, it's gone through some trials and tribulations, right? Definitely affected by COVID. Building large projects has a lot of issues around it, right? We were effectively delayed for 2 years while under construction on the first tower. So, but it's a beautiful project. I'm incredibly proud of it as a Philadelphian. I think we pretty much got close to getting our money out, despite going through the GFC, right? We did all this and put it in place before the GFC, and then the development happened kind of coming out of it and after, and then COVID, and then we ran into COVID. So it was a mixed bag, but it's a great project. I think it should have taught me that I'd never do development ever again, because it's just so difficult and so long, right? You have to survive a very, very long cycle in order to be successful on a development deal,
right?
Or get really lucky during a long cycle. So, but it's a great project.
Yeah, and I'm sure a lot of things outside of your control as well.
Yeah,
so,
exactly.
So Larry, as we think about the trajectory of raising capital from private to institutional, so you have spent time thinking about tapping into the public markets. So maybe talk a little bit about the potential opportunity there, whether it's an IPO, whether it's joining forces with a publicly traded company, and access to the public markets. How do you look at that as the next step?
So, I mean, real estate is kind of the illiquid asset class, and all of us in the business spend all of our time trying to find liquidity. I'd always believed, especially kind of getting into the business in the early 90s and understanding securitization, efficient market theory, securitization, the public markets, that the best route to consistent liquidity was being in the public markets, right? Being a REIT. And when we were coming out of the GFC, we had aggregated a portfolio of about, I guess, $300 or $400 million. We had 16 office assets, mostly on the Northeast. And at the time, you could go public if you got like $500 million. If you got $500 million in market value, that was sort of the trigger. And we spent a lot of time trying to figure out a partner to come in. And basically, there was this whole narrative around how New York and DC were going to come back more quickly than everywhere else, which it did from an investment perspective. Couldn't figure it out. There was just too many guys in too much trouble to sort of say, yeah, here's $200 million worth of assets, go public, or let's go public. Coming out of the COVID, it was sort of the same math. I mean, we were much smaller. The Creekside deal was not ready to go into basically get traded at a lower valuation into a public entity, but the rest of the assets were. So we spent about a year and a half trying to go public with 4 out of our 6 assets, or 3 out of our 6 assets. And it's a process, and there's a lot of, as you said, a lot of things out of your control. It's very any geopolitical, you're basically getting slapped around by the public markets before you even start being public. So after working on it for about a year and a half, when we were actually clear to launch from the SEC, which took a lot of trials and tribulations, the IPO market for small cap any businesses just wasn't there. And we were registered on the NYSE Amex. We had a full S11 filed and approved. We had everything lined up and ready to go, and just couldn't raise $25 million, which is pretty shocking given what we're talking about and other monies that we have raised. But that's the public markets. What will eventually happen is, it seems, fingers crossed, is that we'll be able to accomplish what we were trying to accomplish in a slightly different way. But again, to me, it's especially with this opportunity out there in office, I need liquidity, right? I need the liquidity to execute it. I'm not finding it anywhere else. And, to me, the public markets, then you can deal with the crappy debt quotes that I'm getting, so long as you have access to equity. But just think about it. if I can go into the public markets and raise money, and let's say equity at a 9 or even a 10, and then I can go invest it, like we're talking about, these deals and what types of equity returns they could have, even on a cash basis. You're taking that money, you're investing it on a cash basis in the high teens right away.
Mm-hmm.
And then overall, you're probably looking at, somewhere in the high 20s to 30 on an overall return under very conservative assumptions.
Yeah.
That creates value in the stock market, eventually. Obviously, you're subject to the whims and public perception and all of that. But I think you can build a real fundamental business around that with access to liquidity in the public markets.
Yeah. I mean, shifting gears a little bit, this is something I know James and I are both really excited to ask you about. So you've run sports and real estate side by side for years. You're also president of Alliance Sports. So you have a portfolio of minor league teams while also running Joss simultaneously. Let's dig into that. Where did this interest come from? What does this entail? And like, how did you even get involved in that?
Yeah. So, I mean, it's literally as easy as Gary Green, Steve's son, right? And I are really good friends, go back a long, long time. We were sitting around in like 2008 saying, let's go figure out minor league baseball. So we spent a year running around looking at different opportunities. And again, same private equity model, right? High net worth investors, promote structures, fees, all that kind of stuff. So to me, like, that's the easy part. It's like, oh, here's a real estate deal versus a minor league baseball team. So we wound up, flash forward to a few years ago, we wound up buying 3 minor league baseball teams, the Richmond Flying Squirrels, the Omaha Storm Chasers, and the Montgomery Biscuits. We bought Baseball America magazine, which was a whole nother like education and publishing. And then we started a soccer team in Omaha, which is playing in USL League One, which is like level 3 US soccer. So, since then we have sold Montgomery and Omaha to private equity. Back then it was all friends and family. There was no debt. There was no like institutional capital in the business. And so all the money was raised amongst all of our friends as we cobbled this stuff together. And I think we bought the Squirrels we basically recapitalized that deal with the existing partner. It was like a $12 million valuation. I think Omaha was 18.
Is that on a multiple EBITDA, or how do they trade?
Back then it was on stick value of what level they were at, which makes no sense.
Okay.
But now these things, now that private equity has come in, they trade on multiples. And we did fine. The couple that we've sold, we did okay. That's more about the capital that came into the business over the last like 3 or 4 years. Silver Lake bought 50 minor league baseball teams over the last 36 months. 50.
Wow.
They're $2 billion long, the minor league baseball business. Thank God, because it gave us liquidity and a better understanding of like what value was. And we took advantage of it on a couple of things. Avenue bought, which is Mark Lazary, bought Montgomery. So there's Arctos was just bought by KR. They're buying a minor league baseball team or two. So there's all this liquidity that's come into the minor league baseball business, which is great. But our best deal will be Richmond. And fundamentally, we open the new stadium this year. Richmond's a great market and these are the fundamentals of like where you can be wildly successful. Good market, no competition, right? There's no Big Ten school that dominates the headlines. And we got a new stadium built. And that our revenue increase from the old stadium, which is literally across the street, so it's nothing to do with geography, will be close to 4 times what we were making in the old stadium we'll make in the new stadium.
What are some of the synergies between buying baseball teams and buying real estate?
So, well, I mean, what's also happened that's pretty interesting in the 15 or 16 years of us being in the business is the business has evolved, which is why a lot of the private equity money is there to be real estate deals. Build a new stadium and then build a few hundred apartments around this. We're going to hopefully be able to execute this in Omaha, where we're building a new soccer stadium. We have 10 acres of land adjacent to it that we're going to need to develop, as part of the deal. And it helps support the costs of building the soccer stadium, which you need to make all this work, because a stadium's worth nothing unless a team is playing in it. Right. So it's not really a real estate asset. So you need these other real estate assets and able to support it. That's become a huge part of the sports business. And it not just at the minor league level, at the professional level. Every stadium development has a adjacent mixed use, massive real estate development associated with it.
From an investment strategy standpoint, when you're buying a sports team, what are some of the ways that you can add value, so that when you sell it, you're actually making a good investment?
Yeah, I mean, one of the theories that we had was that the capital was, and this is like, again, New York finance guy thinking about the business, the capital was so inefficient. It was like, okay, buy a team for 20 million bucks. You can maybe put a $2 million loan on it. You had to raise all the rest high net worth. That's like a horrendous capital structure. So what has evolved is now that private equity has come in, right? Instead of, let's say, 20% returns that the high net worths want to see, private equity is like, oh, we could live with a 12, right? And they're also willing to allow more financing. So all of a sudden, instead of having a, let's say, a cost of capital at an 18, which we probably did have on some of these things, now you're like closer to a 10. And that obviously just creates value. The good part about minor league baseball is the major league teams pay the players. So you can actually make money, right? You can make money in the business, like on a day-to-day basis with, your boots on the ground operation and selling tickets, concessions, merchandise, sponsorships. Soccer, you pay the players. You're not making that. You're not doing that. You're kind of carrying these things. So there's a big difference between soccer and minor league baseball.
Interesting.
But it's a totally different business. Like you go into the publishing business for ages, for another podcast. And it's to me, look, I was doing real estate for 30 plus years. It sort of kept the clock going, right? It keeps you energized and keeps you interested in what you're doing and keeps you going to be able to do this for a long time, which 40 years is a long time. So it's great.
Well, Larry, this was awesome. Thank you so much for sharing. I mean, it's amazing to hear what you've done on the real estate side, let alone with Alliance Sports. So we really appreciate you taking the time to share with our audience.
Thanks for having me. This was great.
And as always, we want to thank our audience, both myself, my co-host, Kim Troller. I know you probably got a tremendous amount of value from this. The best thing you can do is share this with a friend, forward this on. That's how we continue to grow this and help you provide and get the insider's edge. So until next week, thank you again for joining.